Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the stock play of the day. Today's stock is Apple. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I am the senior options analyst at Ally Invest. On today's stock play of the day, we're going to look at year-end strategies. And our underlying stock that we're going to talk about is Apple. And what might we want, how we might want to use options to enhance our Apple position based off of where your cost basis is, what your plans are for Apple going into the new year. Now, you can take these concepts and you can apply them to any other stock that you might have, but I always like to think about options, especially going into the new year, and how I can use this to enhance my stock portfolio. So that's the main theme today, but let's get into what's going on in the marketplace. We see the S&P 500 index has been struggling of late. But we got the 200-day moving average below the 50-day moving average, below the 20-day moving average. And overall, that's a good sign for the marketplace. As far as the news is concerned, there's a little bit more angst in the marketplace, and that's shown by the VIX. So let me go and pull up the VIX index. The VIX has been all over the place as of late. If we look at the actual chart in the VIX, wasn't that long ago that we shot all the way up to about the 30 to 35 range, which is, we haven't been that high. I'm going to zoom back here, going all the way back to right after the pandemic. The last time that we broke through the 35 level was November of over almost a year ago now at this point in time, I guess over a year ago. So we haven't seen these ranges in the VIX in quite some time. The market settled down. The VIX came down precipitously. We got down to the 20% level. Everything was fine. The sky was not falling anymore. But then all of a sudden, inflationary concerns popped right back up again. And what we've seen is a flight to quality recently. The Fed is going to be meeting this week. They're going to be chatting a little bit. A lot of people are going to be hanging on their words after the meeting and how fast they want to react to inflationary concerns. So because of that, it's added volatility to the marketplace as a whole. We see the VIX index right now at 2278. Once again, I always consider anything above that 20% level to be fairly high volatility. That line in the sand was drawn after the pandemic downturn from a couple of years ago. It took a long time, if you look at the VIX chart, to get below that 20% level. Now we still struggle with it from time to time. And there is concern about the marketplace and what's going to happen tomorrow as far as the Fed is concerned. I think all eyes are on the Fed this week more than anything. We see the S&P 500 index right now is down about 1%. NASDAQ is down a little bit more than that, and the Russell is holding its own. But the Russell is back into its trading channel once again, and is for a minute there, it was good news in the Russell. We were breaking through to new highs on the index overall. And by the way, this is the ETF that tracks the Russell, the IWM. But overall, we were seeing good news as far as the Russell was concerned, trying to drive the markets higher, but that didn't last for long. So now the Russell is still the wild card here. The NASDAQ is trailing the S&P 500 index a little bit. A lot of people would say a flight to quality. We're seeing the meme stock struggle a little bit. They were up a little bit this morning overall, but it's hard in an inflationary environment to be in companies that just really don't have earnings. And So even stocks like Tesla have struggled a little bit because of their valuation. But Mr. Musk came out and is selling some more stock overall, but is forced to because has a big tax implication that it came from exercising some option contracts overall. Moral to the story is we're seeing stocks like utilities, some of the retail stocks go higher for the first time in a while. The only FANG stock that's really holding its own is Apple. And that's part of the reason why we're going to talk about it today. Not necessarily saying that we're going to go out and we're going to be bullish on Apple, but we're going to talk about what might happen with Apple today going into the new year. So right now we see Apple is down about 1.5% on the marketplace. So fairly similar to where the actual market is at. Apple's done a good job of holding it up, actually. Apple has been the one bright spot out of the FANG stocks, Facebook, Amazon, Netflix, all of the, well, Facebook is now Meta, by the way. That's their new company name. All those companies are kind of struggling. Google is kind of holding its own a little bit in there too, but mainly Apple is the bright spot. And one of the things that is concerning about Apple is how quickly it has rose. So here's our Apple chart. This is a daily chart on Apple, and we see that you've had a huge, like basically it was acting like a brand like a brand new company. The way that it all of a sudden we broke out to a new high, and we had a real strong showing all the way up to the 180 level. At this point in time, we have once again the 200-day below the 50-day, below the 20-day moving average. But some people might be concerned that it was too fast, too soon. We've even looked at Apple on my Options Playbook radio podcast. We talked a little bit about if Apple had been reaching a new high way back in this little range, like how might I trade it? What is one thing that we could do to participate in the Apple move without all the risk? And we talked about buying an in the money call option as an alternative to just buying the stock outright. So now I want to talk about people that may have positions in Apple. Almost everybody in some way, shape, or form owns some Apple. If you think of 401ks that track all the different major indexes, most of them have some exposure to Apple overall. So a lot of people have their eyes on Apple, and right now it's one of the only stocks that's really propping up the market. So if I have a position, and I don't necessarily want you to think about this as a show about Apple in general. I want you to take this approach, and as usual on the stock play of the day, it's all meant to be a learning situation. We look inside the options playbook. We try to pick a strategy that we can apply to our situation as far as the stocks are concerned. So the stocks are trading at this level. We got this implied volatility. What's an option strategy that we could use to try to match our forecast for that underlying stock? And going into year end, some people want to take some profits. Some people want to take some losses. And option trading can help you do that. So the strategy that I'm going to look at today, and this stock play of the day, is going to be way more strategy focused than ordinary. We're going to talk a lot about how to use options around a stock position. We're going to basically leg into what's called a collar. So if I go into the Options Playbook website and I look at the rookie strategies, we have three of them that I like to highlight when I'm talking to people, beginning option traders, basically stock traders that want to get into the options marketplace. And the strategies that we are highlighting under the rookies tab here is a covered call, a protective put, and a collar. Guess what? The collar has all three of these in each and every one of these strategies are a part of the collar position. So let's first talk about the covered call. Let's say we have a stock that we don't mind selling if it goes higher, or we have a stock that we have a loss on and we wouldn't mind taking that loss going into year end so that we have a loss on the books. Sometimes you got to offset some of the gains with losses as we go into the year end, as far as your portfolio is concerned. Now, we don't give tax advice here at Ally Invest, so a small disclaimer there. But these are things that normal people that have a portfolio of stocks think about as we go into the year end. What's one strategy that we can do? If we have 100 shares of Apple, we can sell a covered call against it. We had a big run up in the underlying stock. So let's say, well, if it goes up anymore, I wouldn't mind selling that stock at a higher price. Now, I have to emphasize here that if you're doing a covered call, you do have to have 100 shares of the underlying stock to be able to sell something against that position. And if you do have that 100 shares, if you do have 100 shares of Apple, you can target a sell price by selling a call against the position. And a lot of people, when they're looking at covered call trading, they usually like to do it after the fact. I've had a gain on the underlying stock. If it goes up a little bit more, I don't mind selling it. Very rarely do you see somebody buy a stock. I'm not going to say very rarely. I should probably make that a little less harsh. But it's not very often that you see people that buy a stock and then sell a call instantly against it. When they're doing that, they're saying, well, I'm buying the stock because I think it's going to go up, but I'm already going to limit the opportunity on the upside, right? So if you're buying stock, usually you buy it because you think it's going to go up. You don't want to limit your upside potential. So it's more common for people to do it after the fact than to do it right when they first buy that stock. Now, I'm going to stay in the playbook for a second longer and to say, okay, well, what if I own the stock and I don't want to sell it, but we did have a big run up in Apple. I'm a little bit worried about the downside. So now what could we do in that situation? Well, that's called a protective put. That means that we're going to buy a put that's going to limit our downside on the underlying stock. It's going to fixate a sell price for it, but that costs something as opposed to bringing cash in to help offset some of the cost of owning the stock. We're going to actually spend that cash. And if we spend that cash, that means that we get a benefit. And that benefit would be that we can sell the stock at that strike price. So we're going to look at that strategy too. And then guess what? We're still dealing with that 100 shares of this paper trade on Apple per se. What if we combine them both? I don't really like paying for insurance, and the options world actually allows you to sell a call and use that credit to help pay for a protected put. And if we do that, we combine both of these strategies, the covered call and the protected put, we end up with a collar. And it looks something like this. So I'm going to go through all three of these tabs real quick, like in the options playbook. So the covered call is what's limiting our upside. It's fixating a sell price, saying that if it goes up, you can take my stock away. For that, I receive cash, but I take on that obligation. And then the protected put says, well, I'm going to pay cash, but I'm going to limit that downside. I'm going to have a price at which I could put the stock to somebody. So if we go back to the collar strategy, guess what? This little kink in the graph on the profit and loss is the covered call position. This little kink in the graph that's limiting our risk on the downside is the collar position. And in between strike A and strike B on our profit and loss graph, guess what? That's the stock that's driving that, the actual stock price movement. So let's look at all three of these. Let's approach how we might want to think about this if we do have any stock. Like I say, once again, a stock that I have a gain on overall. There are many of them that are out there, but we're just going to use Apple because Apple actually has been one of the strongest stocks out of the big name brand stocks that are out there that's holding the marketplace up. All right. So if I run to the Ally Invest option chains, let me get the chains up here. That's the chart. We see Apple right now down about what the market, well, about what the NASDAQ is right now, down about $3.28 on the day. We are going to look at an expiration that's going to take us out into the new year. Now, the concept is that this is a year-end strategy. So if I'm worried about Apple going into the year end, or I want to sell Apple over, or I'm willing to sell, let's say I'm willing to sell Apple, well, then I want to probably use a January expiration to do that. So I'm going to do the normal monthly expiration. These are the expirations that are available. I'm okay with January 14th. But the normal monthly, the third Friday of the month is January 21st this year. That's 38 days away. So I'm not going too far out in time. If I were looking to sell the stock prior to the year end, if I wanted to create a capital gain, if I will, I would assume that you would have a gain, considering where Apple is at, unless you just bought it yesterday overall. Then I would target the December 31st or the December 23rd uh, expirations, right? If I'm looking at doing a covered call and I'm willing to sell the stock if it goes a little bit higher. We're going to leg into all three of these positions. We're going to start with a covered call. We're going to look at using that cash to buy a put, and then eventually we would have a caller on our position. And that's the way that we're going to roll with this trade today. So those are all of my disclaimers that are around it. Think about your stock portfolio. Think about stocks that you would consider some year-end cleaning up of your portfolio, and think about how options can help you do that. All right. So at this point in time, if I look at Apple and I look at the January 21st expiration, 38 days away, we got Apple trading at 172. I'm going to look at the 190 call option. Okay. So I'm giving myself a good bit of upside overall. Actually, we could even go a little bit higher if you wanted to. You could look, let me see what the 195 is at. I'm going to start with the 190. Okay. So the 190 is 172 by 174, which real good market overall on. 195 is 112 by 113. So you're still getting a decent premium, even going out to the 195 situation, which if we do the math on this real quick, the 190 means that we are 18 points away from where the market is at approximately. Obviously, if we go to 195, now we're talking about 22 some points away. If we look at the actual expected move, like what the long straddle would be on Apple, if I bought the put and I bought the call, what's the marketplace think the potential move would be? At the 170 level, I guess we're kind of right in the middle there. We don't have an at the money option, right? But you're talking about 9 plus 6, talking about 15 points. So the 190 is outside of what the marketplace thinks the move could be, right? That's the expected move. That's the over under. That's the line in the sand that they're saying. Marketplace think if it goes more than that, then it moved more than what the marketplace was thinking. And if it goes less than that, less than the 15 points, then it's moving less than what the marketplace is thinking. That's the general concept that we use day in and day out in the option trading world. So I don't mind selling the 190 in this scenario. Now, on the downside, where do you want your protection? If I buy the 165, that's 7 points away from where, well, $7.50. I'm just going to use round numbers here. But that's trading for $4.15. So if I were to do a covered call, I would think about selling the 190 strike on my 100 shares of stock on Apple. Remember, our fictitious position here means that we have 100 shares of Apple. I could just sell that, bring in that cash above and beyond any dividends that Apple pays, and I get that cash now. I can use that to reduce my cost basis. Whatever I want to do with that cash, I'm okay with. So I'm receiving $170 for just saying that if Apple goes to 190, I'm okay with selling it. But my main concern now is the downside. We had the big move up. I'm going to run over to the chart here 1 second on Apple. And so where did that start? 157 is where it started, that big move up on Apple overall. So what if we come back to that level? You'd obviously hope that we'd get some support from that breakout area in that range. 165 is about right here on the chart, and here's 170, and we see where the underlying stock is at right now, 172.50 or so. All right. Now on the high end, we hit all the way up to, it looks like, what's the all-time high here on Apple? 182.13. So ideally, this would have been a nice thought if we would have talked about Apple just a few days back on last week's stock play of the day. But we don't pick what day we get to do the stock play today. It's Tuesday at noon. So if I'm thinking that way and I sell that call, I'm okay with just selling the call. I could sell it in the December expiration. We're going to be talking about the January expiration. And then now I'm going to take the proceeds and I think I'm going to buy the 160. I don't necessarily want to pay $4 for a 165, 7 points away, but you can think of this as a deductible. At 165, we're about $7.40 away from where the current underlying stock is at. That would be my deductible. That would be my, if I'm thinking of this as a true insurance product, my car insurance, do you have the $500 deductible or the $1,000 deductible? And this, ours would be 700 approximately, because we're talking about where that underlying stock is at down to that strike price of 165. And if I own 100 shares of stock, that would be about $700 before my insurance product would kick in. Now, if I just buy that outright, the 415, well, let me put it this way. If I was just buying a protected put, I'd probably look at the 160 because of the overall cost. I might look at the 165 if we do the collar because I'm bringing in a decent amount of credit by selling the 190 strike call option overall. So I'm going to highlight the 160. That means that our insurance product is going to kick in about 12 points, $12.35 below where the current marketplace is at. And if I click buy, well, then we have our collared position. You already have 100 shares of stock. You could enter this all as one trade, but I am saying that if the stock by that January 38th expiration goes up to 190, I will take on the obligation to sell my stock at that strike price. If the market comes down to 160, I have the right to put my 100 shares of Apple to somebody at 160. I'm putting this entire gaggle of securities to enhance my stock, to be centered around my stock, and I'm putting it on for $1.18 or $118 plus commission if I can fill at that midpoint. Now, don't forget, you already own the 100 shares of stock. I'm going to put this in the right rail, and this would become the official paper trade. And I will walk through once again exactly what we were looking at as far as the strategies are concerned. We're looking to sell to open, January 22nd expiration, 190 strike call, buy to open, January 21st expiration, 160 strike put, a net debit of it's 114 right now. I'll click on that. I'm always going to work option orders somewhere by the midpoint, but this is a real tight market. So you're 110 by 114, you're looking at 4 cents wide on the marketplace. I would probably be willing to give up a penny or two just to get an instant fill on the trade overall. And once we do that, remember, here's our strategy. We own the stock, we sold a call, limiting our upside. We own the stock. If we buy the protected put, we limit our downside, still have unlimited upside. If we do all three, we lower the cost and we end up with a profit and loss graph that looks like this. At that expiration date, we have the put at strike A, we have the sold call at strike B, and we own the stock in between. Stocks below strike A, we take our ball and go home. We don't play anymore. But on the upside, that's also the case. We give up some opportunity. Stocks above 190, we also give up our stock at 190, and we just don't play anymore over that. We only participate between strike A and strike B overall. Now, I will go back and I'll say, well, if you don't want to pay for your insurance at all, there's actually something that's called a zero cost collar. That's the official paper trade for this week. Get rid of it out of the right red. And some people might say, well, I don't, 190, that's kind of high. Well, why don't I buy the 180 or sell the 185, give up 5 more points, but then that almost covers my insurance. And then it's considered a zero cost collar. In other words, I'm doing it for next to nothing in the account. I still get the limited downside, but I don't get as much upside on the trade overall. And that's just one way to look at it. So let's get to some questions. Please put them in the chat box right now. I'll address any questions. And it can be about any underlying stock that you're kind of looking at overall. But I'm going to run to the chat box here and got a couple of people saying hello. Hi, William. Hi, Nadeem. And then if we have any general questions about option specific strategies around a stock that you might have in your portfolio, has this spiked any thoughts? Please just let me know. Look in the chat box overall. All right. Now, as I'm waiting for questions, I don't see any in the chat box right now. Let me emphasize that we have done a rookies course on options, actually inside the Ally Invest YouTube channel. We do have a playlist called the Rookies Course on Option Trading. And if you would like to search for that after we get done, I'm not going to be able to put that in the chat box right now, but just go to the Ally YouTube channel. And that's a 3-part, 1-hour series, free to all, about the options course, about these basic option strategies overall. And this stock play of the day actually kind of enhances that, because we talked a little bit about covered call writing. We talked a lot about just buying option contracts overall and the pricing of them. And this little video that we're doing today, I always like to do it at year end and just talk about using options to enhance your stock portfolio, which is going to be a webinar that we're going to do in more detail, actually, as we get into the new year and look at doing more big events like the Rookies Course on Options. All right. So I do have a couple of questions in the chat box, and we'll address them here. We're right at the 12:30 time frame, but I'll address a couple. Morning, correction, then rebound, or rebound, then correction. What is most likely in general? Well, let's talk to the Fed tomorrow. I think their statement after their meeting is going to be more important than it has been all year long. So what the Fed says is part of the reason why I think the VIX spiked a little bit today. And it's really hard. What are they going to say about tapering? What are they going to say about inflation? Those are the concerns that are in the marketplace right now. There is a flight to quality at this point in time, risk off as opposed to risk on scenario. People aren't quite as comfortable as they were in the summer. Nowadays, I actually saw a little something that a couple of months ago, the variants on COVID were the main driver of the marketplace. And now that thought has completely changed, and most consumers are worried about inflation overall. Could you do a video that explains what option permissions you need with Ally to perform which strategies? Yes, very simple. You do need to fill out an option application if you are going to trade options. Now, I will highlight in this venue that you can trade options in retirement portfolios like IRAs, like Roths. You can do that if you are approved. So this strategy that we're talking about, the covered call and the collar, yeah, you can do that in an IRA account if you would like. And then it's not all about the tax implications. It's more about the fact that you had a big run up on Apple and maybe you're a little bit nervous about giving a lot of it back overall. And on top of it, you can always just sell the collar too. An IRA account is a perfect example of that. You put the collar on, the stock does come down to the 155 level. You can just buy to close the short option contract and sell to close the long option contract and remain long the stock overall. Especially in an IRA account, that's a very common thing to do because you're not worried about tax implications inside a retirement shell. Would you close this trade by year end to take a tax deduction? Charles, that's what this whole thing is about. That's a great question. I don't know. The question would be, what are you using in your portfolio of stocks? How could you use these strategies to help you address those questions, to address those concerns, to maybe sell a stock that you want to get out of, to protect a stock like Apple that's had a big run up overall? So that's what the show is about. And it's all about your portfolio and how you want to use options to enhance it as we go into the year end. All right. And that was a great question to end on. My name is Brian Overby. I'm known as the options guy here at Ally Invest. You can email me at theoptionsguy@invest.ally.com and ask me any questions overall. And also, please follow me on Twitter. I've been tweeting about all the educational events that we've been doing. My handle is very simple. It's at Brian Overby. And please click subscribe, ring the bell. We're going to have, we're still going to be doing a lot of the stock plays of the day going into the new year. Obviously, we're going to run into holidays, so there's going to be some hit and miss. You want to make sure that you get alerts on all of them. Click subscribe, ring the bell, and we'll let you know when the next stock play of the day is going to be. And we'll see you this Friday for the stock play of the day overtime. All right. Thanks, everyone.